Time now for our weekly market monitor, who has names of stocks that he says will hold up in an escalating trade war. Andy Kapyrin is back with us. He's Director of Research at RegentAtlantic. Welcome back. Good to see you again.
Nice to see you. First
on the list, Anthem, an insurance company. Now, it's been a steady riser for a few years, but it's been very volatile this year. But you think it holds up in the trade war. Why?
Well, first, let's get the 900-pound gorilla out of the way. Health insurance, in particular, has been in the sights of the White House, of politics generally. There's a number of things that Anthem is doing that will help it catch up to other peers within insurance. In particular, the leader in the space is United Healthcare out of Minnesota. They run a pharmacy benefit manager themselves. Now, this is a way to get additional discounts and rebates out of the pharmaceutical trade, which is a big and growing cost for health insurers.
Right.
What Anthem is now able to do, or will be able to do when they build this out, is match prices with some of their peers that will allow them to compete better in commercial spaces. It'll also allow them to continue to roll out more Medicare Advantage plans, which are incredibly important in that industry. So lots of potential growth. Why is it an insulation from the trade war? It's because they only do business here in America.
That's a good point. Royal Dutch Shell is your second one. Why that one in particular in that industry?
So super majors in the oil industry are a good bet when you don't know where the direction of oil is going to take you, or if you just expect it to be very volatile. Take just 2 days ago, two tankers damaged in the Persian Gulf.
Right.
They are less sensitive to those events, both on the upside and on the downside, and that's a good thing. Royal Dutch Shell, in particular, as a European super major, trades at a big discount to its American peers, Exxon and Chevron, in spite of having a solid business.
All right. Finally, Google. Now, there's a company that's in the crosshairs as well of the federal government, and the stock has suffered as a result here. Why do you like that one here?
So, two reasons. One is I think the regulatory angle is overplayed. It is, in fact, a monopoly. It is, in fact, going to face more regulation, but I don't think it faces a breakup because there isn't a cohesive group other than ad sales that can really be split off from the business. Think about all the other things that Google does. Google Maps, for example, all that is designed to steer eyeballs back to Google for advertising. There isn't really a good way to split it up. As long as you look past that, you have a mature company, highly profitable, that really has a lot of capacity to continue to grow, does so at high profit margins with almost no debt, and does so with almost no revenue from China. It was kicked out of China almost 10 years ago.
All right. We will see what happens. Andy, always good to see you. Thank you.
Thank you, sir.
Andy Kapyrin with RegentAtlantic. And if you want to read more about his picks, you can head to our website at nbr.com.